Meet two investors, both 30 years old. Both invest exactly $400 a month into the same simple index fund. No exceptions, no skipped months. The only difference between them is that one of them started 5 years before the other. Here's what should happen, according to basic math. The early starter should have roughly 5 extra years of $400 contributions, which is $24,000 more, put in. That's it. That's the whole difference. Simple enough. Here's what actually happens. By the time we compare both investors at the same age, the early starter isn't ahead by $24,000. She's ahead by more than double that. Same monthly contribution, same fund, same market, and the gap between them isn't explained by how much money either of them put in. It's explained by something that kicks in specifically around $50,000 invested, and almost nobody talks about why that number matters mechanically, not just emotionally. I'm Ellie, and I make videos about the numbers behind the decisions everyone assumes are obvious, but usually aren't. If you've ever wondered why some investors seem to pull ahead for no visible reason, stick around, because by the end of this video, you'll understand exactly what changes the moment your portfolio crosses $50,000. Hit subscribe if that sounds useful. Let's get into it. Let's meet the early starter. Her name is Naomi. 25 years old when she started, works as a mechanical engineer, invests $400 a month into a simple total market index fund with an assumed 8% average annual return, a commonly used conservative estimate that sits between the stock market's long-term nominal average of around 10% and its inflation-adjusted average closer to 7%, though no return is ever guaranteed year to year. In year one, Naomi contributes $4,800. Her portfolio, with modest growth along the way, ends the year around $5,000. Almost her entire balance is money she personally put in. The growth is barely noticeable, a couple $100, easy to miss if you're not looking closely. By year 3, Naomi has contributed $14,400 total. Her portfolio sits around $16,200. Growth is starting to show up, roughly $1,800 of her balance now, but her own contributions are still doing almost all the heavy lifting. This is the phase most new investors live in for years, and it's also the phase where investing feels the most like just saving, except in a slightly riskier account. By year 8, something starts to shift. Naomi has contributed $38,400 total. Her portfolio has crossed $51,000. Here's the number that actually matters. In that 8th year alone, Naomi contributed $4,800, same as always. But her portfolio grew by roughly $3,600 from market returns in that single year, on top of her contribution. Her own money and her portfolio's growth are now doing almost equal amounts of work in a single year, for the first time. This is the threshold. Around $50,000 invested, assuming a typical 8% annual return, your portfolio's growth in a given year starts approaching and eventually exceeding what you're contributing yourself. Below $50,000, you are the primary engine of your own portfolio's growth. Above it, increasingly, the portfolio becomes its own engine, and you become more of a passenger who occasionally adds fuel. Now let's meet the later starter. His name is Derek. Same 8% assumed return, same $400 monthly contribution, same fund, but Derek started 5 years after Naomi, at age 30 instead of 25. By his 8th year of investing, at age 38, Derek has contributed the same $38,400 Naomi contributed at her own 8th year. His portfolio has also crossed $51,000, essentially matching where Naomi was at the same stage of her own investing timeline. So far, identical results for identical effort. This is the part that surprises people, because up to this point, starting later hasn't cost Derek anything measurable. He's exactly where Naomi was after 8 years of contributing. But now, let's compare them at the same calendar age, 38, rather than the same number of years invested. At age 38, Naomi has been investing for 13 years, not 8, because she started 5 years earlier. Her portfolio at that point has grown to approximately $103,000. Derek, at the exact same age, with his 8 years of investing, sits at his $51,000 mark. The gap between them at age 38 is approximately $52,000. not the $24,000 gap you'd expect from simply counting 5 extra years of $400 contributions. Let's be precise about where that extra money came from, because this is the part that actually matters. $24,000 of the gap is simply Naomi's 5 extra years of $400 contributions, straightforward and expected. But the remaining roughly $28,000 of the gap is money that Naomi's portfolio generated on its own, compounding on contributions she made years earlier, compounding that Derek's portfolio simply didn't have time to generate because it started 5 years later. Same discipline, same monthly amount. The 5-year head start didn't just add $24,000 of contributions, it added an entire extra compounding runway that generated more than $28,000 on its own, slightly more than the contribution gap itself. This is why the specific age you start, not just how much you contribute, matters so much more than most financial advice acknowledges. Two equally disciplined people, contributing identical amounts with identical consistency, can end up over $50,000 apart purely because of when the clock started on their compounding. Let's talk about what actually changes practically once you're the one crossing $50,000 invested, because the psychology here catches almost everyone off guard, even people who understood the math perfectly well in theory. The first thing that changes is how market swings feel. When your portfolio is worth $8,000, a rough 10% down month costs you $800. Uncomfortable, but recoverable, and honestly easy to shrug off. When your portfolio is worth $50,000, that same 10% down month costs you $5,000. Same percentage, same market conditions. A completely different feeling number because your brain doesn't process percentages, it processes dollars, and $5,000 disappearing in a month registers very differently than $800 does, even though proportionally nothing about the risk actually changed. This is exactly where the classic investing mistake happens, and it happens specifically at this size. Not smaller, not necessarily much larger. Right around here, when the dollar swings become large enough to feel alarming, but the investor hasn't yet developed the emotional calluses that come with experience at this scale. Naomi hit this wall in her 9th year, right after crossing $51,000 when the market dropped roughly 14% over about 6 weeks. Her portfolio, which had just crossed $54,000 by that point in the year, dropped to around $46,400. $7,600 gone, on paper, in 6 weeks. Naomi seriously considered pulling everything into cash. Not because the math had changed, the long-term expected return of the fund hadn't shifted at all, but because seeing $7,600 evaporate felt qualitatively different than any drop she'd experienced in her first several years of investing, when the same percentage drop would have cost her a few $100s, not thousands. She didn't sell. She kept her $400 monthly contribution running exactly as scheduled, buying more shares at the temporarily lower price without changing anything about her plan. 14 months later, the market had not only recovered, but continued its longer-term upward trend, and her portfolio, boosted by both the recovery and continued contributions, had grown past $68,000. The dip that had felt catastrophic at the time became, in hindsight, an unremarkable blip on a chart that kept climbing. Derek, meanwhile, experienced that same market drop in his own 9th year of investing, right around the same $51,000 to $54,000 range Naomi had been in. He reacted differently. Convinced the drop signaled something larger, he moved 60% of his portfolio into cash, planning to wait for things to stabilize before reinvesting. Things stabilized within about 4 months, but Derek waited an additional 5 months beyond that, watching for a clearer signal that never really arrived, before slowly moving back in. In the meantime, he missed roughly the first third of the recovery, the steepest and fastest part of it, which is historically when a large percentage of a rebound's total gain tends to happen. By the time Derek fully reinvested, his portfolio was still recovering, while Naomi's had already surged well past its pre-drop level. This is the part that almost never gets discussed alongside compounding math. The 5-year head start explains most of the gap between Naomi and Derek, but this single moment, one market drop and 2 completely different reactions to the exact same event, widened the gap further, not because Derek was contributing less or making worse long-term decisions in general, but because he made one emotionally understandable decision at exactly the size where dollar swings start feeling dangerous instead of just numerically large. Here's the second thing that changes, and it's more encouraging than the first. Good years start mattering more than good months of contributions. In one particularly strong year for the market, Naomi's $54,000 portfolio grew by over $9,000 from returns alone, more than her entire annual contribution of $4,800, nearly double it. A single strong market year at this portfolio size can now outproduce an entire year of disciplined saving. This cuts both ways. Of course, a bad year can also erase more than a year of contributions on paper, which is exactly why the emotional whiplash intensifies in both directions once you cross this threshold. So what do you actually do with this information? Whether you're approaching $50,000 invested or you're already past it and just started noticing the dollar swings feel different than they used to. First, expect the psychological shift before it happens, not after. Knowing in advance that a 10% drop will feel much bigger in dollar terms, even though nothing about your actual risk exposure has changed, takes some of the shock out of it when it eventually happens, and it will happen. Markets correct regularly. Second, keep your contribution schedule completely separate from your emotional reaction to portfolio swings. Naomi's decision to keep contributing $400 a month through a $7,600 drop wasn't bravery. It was simply refusing to let a temporary paper number change a decision that was based on a much longer timeline than any single 6-week period. Derek's decision to move to cash wasn't recklessness either. It was a completely understandable human reaction to watching a large dollar figure drop quickly. But the outcome for each of them was very different, and the difference had nothing to do with intelligence or discipline in the contributing sense. Third, understand that the acceleration you're feeling once you cross this threshold isn't a fluke or a lucky year. It's the mathematical result of compounding finally having enough of a base to generate meaningful returns alongside your contributions, rather than being overwhelmed by them. It will continue, with volatility in both directions, as long as you don't interrupt it by pulling money out during a downturn. If you're earlier in the journey, still watching your portfolio grow mostly through your own contributions, the honest message is that this phase takes longer than anyone wants it to, often 6 to 10 years, depending on your contribution amount and market conditions. And there's no way to responsibly skip ahead to the acceleration phase without simply continuing to show up month after month the way both Naomi and Derek did in the early years, regardless of which one of them started with a head start. The gap between Naomi and Derek was never fully about discipline. Derek was every bit as consistent as Naomi in his contributions. Part of the gap was about time, and specifically about how much time compounding had to work quietly in the background before either of them ever noticed it happening. But part of it was also about what each of them did in a single 6-week window. Once the dollar amounts at stake finally became large enough to feel like something worth panicking over. If this helped you understand what actually changes once your portfolio crosses $50,000, hit that like button and subscribe for more videos that run the numbers nobody else bothers to run.